Why do some people retire with financial freedom and others struggle and scrape to get by in their golden years? I asked myself this question back in 2010 when I looked at our retirement projections, which looked really great until I put inflation next to it. Then our retirement financial fountain of freedom looked more like a retirement dumpster fire. So I've been on a journey ever since to find out how people that retire financially free, how they do it. And so now I help investors achieve financial freedom by creating streams of tax smart income while growing equity for future generations. Hello, everyone. My name is Brad N. Reed, and I would like to encourage you to be good. And by good, I mean get out of debt, achieve your financial dreams, and give generously to your community. This is the Financial Fountain of Freedom session. This is episode 5, and today I'm going to start into the stock market, talk about how we do a valuation of the market. Spoiler alert, if you're following the stock market right now, it's not doing so good. And I'm going to talk about why. And then also going to talk about how you make money in all three of the market cycles. And then there's a bunch of stuff there in dark orange or brown that I'm going to cover over the next several episodes. It's going to take a couple of weeks, but we'll get to it. My vision is to create a 4-tier service where number one is all about how to get out of debt. Notice the be good, get out of debt. And then number two is aligning your mind, body, and spirit because this stuff is hard. And unless you are strong of body, mind, and spirit, it's going to be, you're going to need that. And one thing I was thinking of recently is you go to school for 18 years and they teach you not to fail. And then as soon as you get out of school, the first thing you realize you got to do is you got to fail in order to win, right? I have certainly failed a bunch in order to get to where I am today. And failure's hard. A lot of people think failure is bad instead of failure is just learning. So I heard someone talking today and they were in a deal for 3 years and it was just the worst 3 years of their life. And now they're out and they said, finally have peace. Folks, life is always going to bring you storms, whether you're read it in the Bible, whether you study Buddhism or whatever, life is going to bring you storms. And it's not about waiting for the storms to pass, it's learning how to dance in the rain. So mind, body, and spirit is about learning your happiness, learning your peace, and learning how to be a powerful individual. Number three is invest for success. That's where we are today. Learn to invest for yourself, build many streams of income, dominate, and achieve your financial dreams. Number four is live your dreams. Do what you want when you want. Be an owner, not an operator. Make money while you sleep. And the idea here is you have passive income that exceeds your spending needs. So you never have to trade your time for your money again. And this is about this section over here. Section 4 is about living in fulfillment. How do you be happy? And how do you give generously to your community? And how do you keep your financial success? Going to cover all of this stuff. Already covered mortgage tips and tricks, getting into stock market today. If you want to study that, hit pause on the video, go over it more. I'm moving on. Folks, this is not financial advice. This is information for education and entertainment only. Nothing in this presentation or video constitutes advice, nor is anything an offer to buy or sell any security, investment, tax, accounting, legal. Investors bear the responsibility for their own decisions and results. Investing and trading involves a high degree of risk of losing a significant amount of money, aka all of it. So, if you do want personalized financial advice, seek a competent and hopefully licensed individual in your area. So, what I'm telling people is that interest rate matters. Don't just get what they say you should be happy with. A couple of changes in your interest rate can mean the difference between a financial fountain of freedom and retirement or a retirement dumpster fire. Inflation increases the cost of living over time. So when you look at your projection for your retirement savings account on your first year of retirement, it's probably going to look like a really big number. But you got to look at the cost of living and how the cost of living is going to increase as well. So you need to look at these two numbers and then calculate your required inflation adjusted rate of return. I will give you a calculator for free to do that for you. Then you compare your required rate of return to your current strategy. Do you need to make any changes at all? If you don't, awesome. Go crush it. If you want to make some changes, stick with me. I'm showing you the changes that I made, how, when, and why, and how you can do it too. That's how you go get the calculator. Monique says, hi, everyone. What's up, Monique? Thanks for being here. If you do not yet have the inflation adjusted retirement calculator, I am typing it into the chat pane now. There you go. And episode 3.5 of the Financial Fountain of Freedom series talks about specifically how to use the calculator. So you can look it up on YouTube and go find it. All right. Your money mindset determines your financial future. Mindset is in that mind, body, and spirit tier, doing a whole tier because money mindset is so important. Calculate your desired rate of return and then structure a great portfolio that, according to Ray Dalio, your investments are diversified, non-correlated with asymmetric risk reward. Peter Mallouk advises to get most of your money into real estate, then 30% into private equity, 15% in public equities such as stocks, 10% in energy, and 5% in alternatives. I'm starting with stocks through this series because that is available to both accredited and non-accredited investors. Most of this other stuff is open just to accredited investors. There are ways if you are not accredited, but those are few and far in between. Maybe we'll get to that later on. Do want to make you aware again that the SEC and actually Donald Trump has been talking about getting access to private equity and private real estate and private investments more open to the general public. And they made another announcement last Friday. So stay aware if you are not accredited, stay on top of it. Donald Trump wanted in his first term to pass a test so that you could gain access to investments normally reserved for accredited investors only. And one of my many tinfoil hat theories is that if investments become open, private investments become open to non-accredited investors, the stock market may be in danger. Because right now, the only place, not the only place, the primary place for non-accredited investors is the stock market. All right, I got off on a tangent. Structure a great portfolio that is diversified, non-correlated with asymmetric risk reward and these different asset classes that serves your needs for cash on cash and equity growth. I am not retired yet, so a lot of my focus for my retirement funds is on equity growth. Once I am retired, my focus is going to be on cash to provide me a awesome golden year lifestyle, but I'm still going to want equity growth to outpace inflation. Indomitable Horizons Funds has investments now. If you're looking for right now, actually, it's a private real estate with a much better returns than typical stock market returns, but go check it out at indomitablehorizons.com. INDHRS.com will get you there. And folks, never forget how we learn is 10% by reading and listening. That's what we are doing today. Okay. By watching this video, you are getting 10% of what you need. You're getting information. You must then discuss it with really smart people and like-minded people that are studying it with you to turn that information into knowledge. But you will never get the skill until you get out there and do it. Think of it as riding a bike, learning how to swim, driving a car. There's only so much you can get by reading a book and watching videos. Sooner or later, you're going to have to talk to other people that are doing it, and you're not going to be skillful to yourself until you get out there and do it. All right. Learn these things, change everything about your performance in the stock market. Today, I'm going to teach you how to make money when a stock is going down. Yep, stock goes down, you can make money. Not going to talk about long puts today, but I will talk about short selling. Next time, I'm going to talk about how to set your entry, a protective stop, and your exit all at once and walk away. That's called OTOCO, order triggers, order cancels order. One of my favorite trades of all time was on USO. And my wife and I were going on vacation to Puerto Rico, where her family lives, but we were going to take some time and sneak off to the Hilton Resort in Ponce down south. And she told me, hey, no stock trading while we're on vacation. I was like, absolutely, sweetheart. Uh, I got it covered. Jeremy's going to cover for me, or Blake's going to, I had people that were going to cover for me because I was working for, I actually founded a stock trading company at this time, co-founded, and I had it all covered. So we're picking up our luggage at, in Puerto Rico, and my phone goes ding, and I had a special ringtone for the messages when a stock trade triggered. And she said, are you trading stocks? And I said, honey, I set this order before we left. And she's like, you did what? Yeah, I got triggered into an order while I'm on vacation. And 2 days later, we're at the pool drinking umbrella drinks, and my phone goes ding. And she said, what was that? And I said, we just tripled up on USO. So I had set an order to buy an option at 10 cents. I had set an order, if that one failed, to sell it at 30 cents, and it hit, and I wasn't near my computer for at least 4 or 5 days. So I'm going to teach you how to do that next time. I'm going to talk to you about how you can buy insurance on stocks that you own. So if you are worried about them going down, buy insurance. How you can earn monthly income while waiting for a stock to hit your buy price, meaning you don't own it, but you are still getting monthly income. And also, once you do own it, to earn monthly income until your shares reach your sell price. Also talk to you about how to lock in your gains and stay in the trade in case it goes higher. And then one of the most fun strategies, not my most profitable one, but most fun one's called a strangle. And you place an order and you make money if it goes up or if it goes down. You don't care which. If it goes sideways, you're hosed. Well, not hosed, but you lose. And then also, if a stock goes sideways and you expect it to continue to go sideways, how you can make money on a stock that's not going up or down. So if you think these are pretty cool tips and tricks, stay with us and let's all learn and study together. This is basically what I'm going to cover in the next, I guess, what is that, 8 episodes, including today. I reserve the right to change things and add things as I see fit. I'll go over this. Candlesticks and reversal and continuation patterns, how to build a trading plan and how to test it. Going to talk about indicators. If you have a favorite indicator, message me and I'll try and work it in. Going to talk about options, the simple part of options, if there is one. Then I'm going to talk about the complex part of options. Going to go into the Greeks and how to use that in your favor. I'm going to talk about some fundamental analysis and how to use earnings as a catalyst, and then talk about portfolio construction of your stock trading portfolio. This is going to cover basically what you want to trade and then when you want to trade it and how to trade it. Okay, that's the point of all of this. Identify what to trade, when to trade it, and how to trade it. All right, what the heck is a stock? I'm looking at the attendee list. Y'all are some pretty smart people. And I think everyone here knows what a stock is. But in case you don't, or you're watching this video, it is an actual piece of ownership of a company. So if you have a share of Apple, congratulations, you own Apple company. If you own Starbucks, if you own a share of Starbucks, you can walk into a Starbucks and order coffee like you own the place, because you do. You at least own a small piece of it. The price of a stock is what someone else is willing to pay for it. This frustrates a lot of people because a lot of people think that someone else should be paying more for their stock than they want to pay for it. So it's what someone else is willing to pay for it. And generally, what people are willing to pay for it has to do with what they expect to happen in the future, not what has already happened. I've had a lot of people send me a headline and say, Brad, this should be good for the company. Why is the stock price not going up? Spoiler alert, what was in the headline has already happened. There's something called efficient market theory, and that basically says when the information is released, the market adjusts instantly. And today, that's with, we have a lot of algo traders. Now we have AI traders. People set up bots that read headlines and then trade stocks just based on the headlines. And a human is never going to be faster than these bots, these algos, and artificial intelligence. And then if you want to peek behind the curtain, the government usually finds out these big news events 2 days before they announced, and then the big retail investors, the really, really big banks, they get notified a day before the headline. So, guess who is the best trader of all time ever? Type it into the chat pane if there's someone that you think is the best trader of all time ever in the history of trading, and it's not even close. Watch in the chat pane. Y'all are my friends. Help me out. That means type in the chat pane. Gordon Gecko, Steve, that's a good one. I appreciate it. Actually, I'm not familiar with his results. I think I know who you're talking about. But for the sake of time, I'm going to go ahead and spoil it. Dennis, you're in the right area. Dennis says the government. Nancy Pelosi. Check out her performance. Uh, it is remarkable. There's a rumor that she gets information before anyone else does, and she can place a stock trade. Her husband is also a fantastic stock trader. And folks, I'm not saying this to get government conspiracy theories. I'm just saying that by the time you and I get information, the stock price is already adjusted. So we need a different kind of edge. One of the ways that common traders value a stock is called the PE ratio. And it's basically the price of the stock compared to the annualized earnings per share. I'm going to talk more about that in a little bit. So ETFs are also important. They're very similar to stocks. Basically, it's a bunch of stocks grouped together. Some of y'all may have heard about mutual funds. An ETF is kind of like a mutual fund, but it just trades on the open market. That means the value of the ETF, the price of the ETF, is what the next person is willing to pay for it. So some of these ETFs, like ticker SPY, tracks the S&P 500. So if you own a share of SPY, you basically get a piece of all 500 companies in the S&P 500. If you want to follow Ray Dalio's advice and you want to be diversified, that would be good to know that you can buy one ETF and actually own a ton of different stocks. SPY is probably one of my favorites because, yeah, you trade SPY and you're basically trading the entire market. Spoiler alert, for those of y'all that are just looking for an 8 to 12% rate of return, if you bought the SPY at its worst time ever and just held it for like 20 years, you would get about an 8% annualized rate of return. If you bought SPY at its lowest and just held it for about 20 years, you would get about a 12% annualized rate of return. So if you're looking for a 10% rate of return and you don't want to learn all this stuff, just buy SPY. And the scary thing is most financial advisors, they get paid to underperform the market. So if you're evaluating a financial advisor, say, hey, how long have you been a financial advisor? What's your return? Fantastic. What did the S&P 500 do in that time frame? They either performed at the SPY and charged their investors for it. They beat the SPY, yay, or they underperformed the SPY and charged their investors to underperform what they can go get. ETFs generally have a much lower cost structure than mutual funds. If you are holding, if there's a stock in it that pays dividends, you get the dividends. And they trade at live market prices, so you can control your entry, your exit, and mutual funds, you cannot do that. All right, want to talk about a sector because a lot of ETFs can trade with a sector. So a sector is just a group of companies in the same industry, such as technology, healthcare, energy, financials. Maybe you think that with the rapid growth of all of these AI companies and the AI data centers, that energy is going to be more profitable. Maybe you don't want to pick an individual energy stock or two or three. Maybe you just want to buy the energy sector ETF. You can do that. Pay one price and own a piece of every stock in the energy sector. I think it's ticker XLE. Don't hold me to that. Do your own research. But if you want to buy a piece of every stock in an entire sector, you can do that. ETFs are awesome. All right. So some more key terms. Analyst. Sam says, yup, it is XLE, like X-ray, Lima, Echo. Thank you, Sam. An analyst is someone who publishes articles on what they think a stock is going to do. Here's the catch. A company who wants someone to do an article on their stock can pay an analyst to do to publish a report. Therefore, it is darn near impossible for you to know if an analyst report is marketing or it's their own independent research. A brokerage company is where you go to place your orders. It's where we do our buying and selling. They talk to a market maker and make it happen. Some of the common ones are Fidelity, Schwab, TD Ameritrade. Robinhood was one of the first ones to do commission-free trades. Interactive brokers, I use them for years, absolutely love them. I found some times where my order was filled incorrectly, and I called Interactive Brokers and I said, hey, this didn't happen right. And they looked at it and they said, wow, you're right. And they put me on hold. They actually called the market maker, and some of these conversations went on for 20, 30 minutes. And they they came back and said, yeah, uh, I argued with the market maker for 20 minutes, but we got you your money back. So Interactive Brokers will do that. Love them. Thank you, Interactive Brokers. Currently today, I trade with Schwab on a platform called Thinkorswim. And I do that because their charting software is awesome. And I'm going to copy this. If you want to open a stock trading account, I like Schwab. I'm going to put that in the chat pane. Their charting platform is the best free charting platform I have seen. I've seen some that are better, that are very expensive, but Thinkorswim is fantastic. And if you don't have any money, you can get in there and uh, you can use it for free for paper trading. I believe your data is delayed by 20 minutes. All right, an exchange is where stocks are bought and sold, such as the New York Stock Exchange, the NASDAQ. CBOE stands for Chicago Board of Exchange. You're going to focus on that Chicago piece. What is the name of the Chicago basketball team? And what's the name of their football team? Type it in the chat pane. Actually, it's no longer their football team. Their football team now belongs to Indiana. But yeah, Chicago Board of Exchange. There you go, Bijan. Thank you. The basketball team are the Bulls, and their football team are the Bears. Get it? That's about stock. It's about options exchange. Anyways, there's also international changes, London, Tokyo, Hong Kong, Toronto. A market maker is the firm that fills your order. Oh, where's my market maker discussion? Well, maybe it's coming up, but there is a firm called the market maker that will make your orders happen. Okay. This is weird. Oh, is it all the way down there? Okay, I'm going to skip here to the market maker. There's something you need to know called the bid-ask spread, and this is done by the market maker. So the thing called the bid is the price you receive when you sell your stock. The ask is the price you pay when you buy your stock. Memorize this, practice this, understand this, know this. So when someone goes to sell a stock over here, uh, this is interesting. I think this is wrong. The person, the seller receives money at the bid. The buyer pays money at the ask. Sam says, I agree. Uh, Fantastic. Um, but in this case, yeah, the bid is 49.95. So when the seller sells this at 49.95, the money goes up to the market maker. The buyer pays $50 and the market maker keeps 5 cents. So the market maker keeps what we call the bid ask spread. If you are buying stock, you will always pay the ask. If you're selling stock, you will always receive the bid. Now, when we get into options, I will show you how to negotiate with the market maker and get a better fill. All right, a bull market is when the stock is going up. It's called a bull market because a bull attacks from the bottom up. The average bull market is typically 5 years, and basically the market will double in a typical bull market. Uh, from 2009 until 2000, well, today, except for a very short time in 2021 and 2023, we had the longest bull market anyone's ever known. Now, one reason we have that is because the government printed so much money that it just couldn't lose. People were getting so much money, they were buying things in the market, and the market just went nuts because of quantitative easing. That's also why we have crazy inflation right now. The bear market are when prices are going down. The average bear market lasts 1.2 years. The decline is about 40%. You don't need to know these differences, but you'll hear three things when the market's going down. You'll hear it called a retrace or a pullback. That's when we haven't yet reached 10%. Currently, the current market pullback is about 8%. So we're in a pullback right now. If it exceeds 10%, we call it a correction. And if we break 20% of a downward movement from the recent high, then that's when it's an official bear market. So CNN and Fox and all of the headlines are going nuts with the current pullback, but it's just a pullback. I've heard a number of animals for the sideways market, but basically it's just sideways. Call it a crab, call it a deer. Here we go to the bid-ask spread. How about we just go look at some bid-ask spreads? Over here on the left are a couple of stocks that I follow. If you look, here's the SPY. I follow that one. In the aftermarket, there's not a lot of volume, so the bid-ask spreads generally get bigger. But right now, the bid is about 656.80. That's what I would pay, or that's what I would receive if I sold a share of SPY. If I were to buy one, it would be 656.90, about 10 cents higher to buy it than to sell it, and the market maker gets the difference. So we are up here, and I show you this chart because there is something called the three arrows rule, and basically as buy sell signals. If we close under the 10 exponential moving average, no, excuse me, under the simple moving average, if we close on the monthly under the 10 simple moving average, that will be a very strong sell signal. Follow me on social media, and I will share with you what happens on March 31st or April 1st. Questions, type them in. Yes, Monique, it's being recorded. I'm sorry you're having connectivity issues. So PE stands for the price to earnings. It is the stock price divided by the earnings per share. And I'm about to show you something as to why I think the market is insanely overvalued right now. And we can talk about just how far down we may have to go. If you have a stock and it's valued at $100, but it has $5 of annual earnings, 100 divided by 5 is 20, which means in a year, you're paying $20 for every $1 of annual earnings. Or another way to say that is you're paying for 20 years of earnings from this company. Again, the reason these stock prices go up and these price to earnings ratios go up is because stock traders generally think that earnings will go up. All right. So here's where we get to one of my most fun things to go look at. It's called the Shiller PE ratio, and it measures the total market value against a 10-year rolling average of inflation adjusting. If you look back 140 years, the average PE ratio adjusted for inflation is 17. $17 in stock price for every $1 of annual earnings. I like to look at the market for the last 20, 25 years because of the super influx of toilet traders. These are people that have access to the stock market, right? People can go sit on a toilet, pull out their cell phone, and trade stocks. The access to the stock market now is insane. We have AI trading stocks, we have algos, we have bots, we have kids trading stocks. Whereas 40, 50, 60 years ago, if you wanted to buy a stock, you generally had to go hunt down a financial advisor or stock trader. You had to talk about what you wanted to buy. You had to write a check. The check had to clear, and then the broker that did the trade for you usually charged you a commission of about 10%. So none of this in and out within minutes and seconds. Type in the chat pane what you think the current inflation adjusted price to earnings ratio is. Type it in. What do you think it is? 140-year average is 17, 20-year average is 27. What do you think? Any guesses? 50? Sam, you're not too far off. Monique says 35. So y'all are thinking that it's way overvalued. Those are good guesses. Looked it up today. It's like 38.00. It is the third highest in 140 years. Actually, before we go on, let's go take a look. So, Brad, what is your magic link for the Shiller PE ratio? Well, how about we do this? Just type in your search bar, Shiller PE ratio. And if you get this one, you get the Shiller PE ratio. And for those of y'all that want to keep up with me, or maybe you want to bookmark it, there you go. So this chart looks at the inflation adjusted price to earnings since before 1880. This thing right in here, that's the stock market crash of 1929. This is the oil crisis in the 1970s. That's the stock market crash of 1987, the biggest drop in one day in the history of ever. So by the way, we are way higher than 1929, way higher than the oil embargo, way higher than 1987 when they thought the price market was the most overpriced and it flash dropped like 20% in a day. This is the dot-com bubble burst. This is the mortgage crisis of 2007 and 2008. That's COVID. Recently, we had exceeded all of those. So when you've heard me say, I think the stock market is way overvalued, this is why. And I watch this thing maybe once a week, a couple of times a month to see where we're at. But yeah, currently at 38, but just recently we were the second most overpriced in the history of ever. All right. Another thing I like to look at is the Buffett Indicator. Buffett Indicator takes the value of all the US stocks and divided by the US GDP. Remember, the stock market is a measure of most of the large companies, and the GDP is made up of large companies, small companies, and government spending. Type it in the chat pane. What do you think the value of the stock market is compared to the entire global domestic output of the United States of America? Give me a number. Give me a percent. What do y'all think it is? Any guesses? Any guesses? I know y'all are typing, and I am worried about running long, so I may pick up the speed here just a little bit. Steve guessed 230. Steve, it was that not too long ago. Not too long ago. It's down to 190%. You Googled it. You cheater. Actually, you're not cheating. You're resourceful, and I like it. You the man, Steve. So, how do you get the Buffett indicator, Brad? Wow, I'm so glad you asked. Buffett indicator. And oh, we get a whole bunch. I think yeah, that's the one that I like. So let me get that. Chat pane, put it there. Ah, Bijan's on it. All right. So there we go. US stock market value over GDP. Now I used AI to find a more up-to-date number. This is as of December 31st, 2025, and the market has gone down. But basically, the the value of the stocks is multiple times of their output. It doesn't make sense to me. I'm in a lot of cash right now and have been for a while because of this. If y'all were watching me on social media, many of y'all are in RMFIA with me in back in January, February. I was saying, hey, I think it's overpriced and I'm scared. Just because it's overpriced doesn't mean it can't go up. The market will stay irrational longer than you can stay liquid. That means you can be placing good trades and things can go wrong. So trade what you see. Don't trade what it should be. All right. So how do you make money when the stock goes up? A lot of y'all will say you buy low and you sell high, right? No big trick there, but how do you buy low and sell high? Well, if the market is truly in an uptrend, and I see a lot of professionals get this wrong. I still see a lot of a lot of analysts, a lot of people on the news, on those news that you're watching, they get this wrong. An uptrend is not an uptrend until you have three consecutive higher lows that you can connect with the line. So support is the price level where buying tends to bounce, and it tends to bounce up. So if I'm drawing a line, I'm going to connect that low, somewhere around in here. You may include that low. My support line can be different than yours. And I see a potential one that I did not draw, but could have. Maybe you want to draw a line in through there. Make it a straight line, not the line that I drew. It would be a slightly different angle, but you can have a different line than me. So the next is resistance. So resistance is the price level where selling tends to come in and push it back down. So the next thing you want to do is make a parallel line and drop it in where you think there's a lot of selling. So I've got 1, 2, 3 higher lows. I'm going to buy on the next higher low. And then I'm going to sell when it gets close to resistance. And when it gets back to support, I'm going to buy. And when it gets close to resistance, I'm going to sell. When it gets close to support, I'm going to buy. When it gets close to resistance, I'm going to sell. When it gets close to support, I'm going to buy. Now, this trade might have lost. Might have. This light blue line right here, that's the 100 simple moving average. We're going to get to that when we talk about indicators. That's traditionally a very strong support. So notice how it broke through the support of the trend line and stopped at the next support. So if I were doing this, I probably would have had a protective stop down there, but let's say I lost on this one. I won on the first three. I lost on the fourth. I'm going to go again here. And if I followed this strategy, I would have won on three, I would have won on four and lost on one, maybe. Okay. So there is no strategy that is foolproof. The trick is to either win more often than when you lose, or win big compared to losing small. I prefer both, winning frequently, and when I lose small. That's how you win on an uptrend. Now, what some of y'all didn't know is that you can sell something you don't own. That's called short selling. So the short up here doesn't have to do with the time period. It means you owe something. It means you owe stocks. You borrow stocks from your broker, you sell them, and then when the stock goes down, you buy to close. So remember, in an uptrend, we buy low, sell high. In a downtrend, we sell high and then buy low. Now, if you get it wrong, you might sell to open, and then the stock price goes up, and you have to buy to close at a higher price. If you sell low, buy high, you lose money. Okay, here's another test. If you buy a stock at $10 and it goes down, what's the worst case scenario? How far can it go? If you buy a stock at 10, you're going long, you're expected to go bullish, you buy it at 10, how low can it go? Sam says 0. You're absolutely right, Sam. How high can it go? If you buy it at 10 and it can go higher, how high can it go? Infinite. Absolutely. Sam's a genius. In that 30% we need to talk to smart people, talk to Sam. Okay, so that would be called asymmetric risk reward when the upside is bigger than the downside. If you sell a stock at 10, how far down can it go? That's the good direction, remember. If you buy it at 10, how far down can it go in the good direction? It can go from 10 down to, it can go lower than 1, actually. It can go all the way to 0, but you're right. It can go down, but it's limited. If you sell it at 10 and you want it to go down, how far can it go up against you? How much can you lose if you short sell a stock at 10? Infinite. You can have infinite loss. Your broker can take everything on one trade that goes wrong. So wait till we talk about protecting your orders and protecting your assets before you start short selling. But the point here is you can sell something you don't own. And the reason the market likes short sellers is that it adds liquidity and tightens the bid-ask spreads. The problem is when the market gets bearish, it goes fast. There's an expression, the bull creeps up the stairs and the bear takes the elevator, is the less traumatic version. Most brokers now charge no commissions for your trades, but if you do short a stock, it's usually an incredibly low interest rate. So if you're in it for a couple of days or maybe a week or two, it's almost nominal. If you're going to short something and hold it for years and years and years, then it might be significant. Since the market goes down fast and it goes up slow, usually when I short the market, I'm in and out in a couple of days, maybe a week or two. So the interest is insignificant to me. All right, now the definition of an uptrend is when you can connect 3 higher lows. A downtrend is defined by 3 lower highs. Okay. I don't care about the lows on a downtrend. I care about the highs. Can I find 3 highs in a row that make a line? Spoiler alert. Yes, I can. And then, just like on the other one, that's what I'm going to call resistance. I'm going to make a parallel line and call that support. I'm going to wait for my 3rd lower high, draw my line, then I'm ready to place an order. I'm going to sell to open. And I'm going to buy to close when it gets close to support. And when it gets back up to resistance, I'm going to sell to open. Probably lost on that trade. But I won big on the first one. I lost small on the second one. And then when I see this 3rd high over here, I'm going to do it again. That'd be pretty early. But if I sell high, I buy low. If I sell high, I can sell high again, double up, buy low. And then it breaks the trend. And I can do it again. Sell high, buy low. The trend is your friend until it ends. The trend is your friend until it ends. So people always say, Brad, how long is this trend going to continue? The answer is until it ends. And I know that's frustrating. I know that's not what you want. But if your trading plan is working, keep trading it until the trend is broken. Now, if it goes sideways, we can draw the support and the resistance, same as we did. The cool thing about these support and resistance line that are horizontal, these things can last for years, even decades. decades. So when you draw a good solid support resistance line that's horizontal, keep it on your chart for a long time. All right. Anybody heard a strategy called buy low, sell high? So I got three times here it came into support. So I'm going to draw my support line there. I'm going to guesstimate resistance about there. Buy low, sell high. Wait for it to come down to support again. Buy there, sell high. Booyah. But you guys now know how to short sell. So how about when it comes into resistance, I'm going to sell high and buy low. And I'm going to sell high and either hold through this or I may take a loss on that one. Sell high again. I'm not going to lose this time because I know how high it can go. I'm going to redraw another line at the top of this, make that resistance, and I would have held through that. So sell high there, leg in again, buy to close, sell high, buy low. So if you can find a stock that's going sideways, rinse and repeat, sell high, buy low, sell high, back and forth, back and forth, back and forth. The buy and hold people, they're making zero, zilch through this, nothing. And you are going back and forth and crushing it. Folks, this is how stock traders gain an edge. They create a system of when to buy and when to sell, and they can do it in an up market, a down market, or a sideways market. Questions, type them in the chat pane. Otherwise, I'm going to summarize, wrap up, and let's all go to bed. I'm Eastern time. I'm tired. So we talked about stocks, ETFs, how to value the market with the Shiller PE ratio and the Buffett indicator. Talked about the three market cycles. The market is, one thing we didn't, all right, quick detour. I want the Shiller PE ratio. The next question is, if we think that the market is due to go down, the question is, how far down can it go? And when I look at this chart, I see a level of support right here, just a little bit below 30. I think the last time it dipped, it bounced at 31 and I missed buying it. But I am going to look at the S&P 500 at these dates. Where was it around then? And that's where I'm going to look for a buy price. Spoiler alert, I've already sold multiple puts way down low. I did get filled on the puts. I will see if they get exercised. But I got paid and I'm waiting to see if they get filled. If they do not, I will do it again next month and get paid, waiting for the market to get down to my buy price. Party on, party people. Okay, here's the curriculum. If you want to study that again, hit pause on the video. Once again, folks, your mindset determines your financial future. If you have not worked on your mindset, do so. I do something just about every single day, most of the time, multiple times a day. Calculate your desired rate of return. Don't just get what you can get. Calculate what you need. Find the best way, the safest way to get the rate of return that you need. Structure a portfolio that is diversified, non-correlated, asymmetric risk reward. Okay, the investments that we just talked about, we talked about how to diversify with ETFs and the SPY. We talked about how to trade with asymmetric risk reward. Win more than when you lose. That's what that means. Now, all public equities are 60% correlated with each other. Stock market, the stocks in the market are 80% correlated with each other. That means when the market's going up, 80% of stocks are going up. Not all of them, but 80%. So an asset allocation, I believe, should include some stocks and public equities. And for the stocks that you choose, get diversified. Remember the sectors. You can choose different sectors. You can choose ETFs, get diversified. You can even get international stocks. You can even get ETFs that make money when the stock goes down. When the market goes down, some ETFs go up. Get diversified. Get your asymmetric risk reward. Get your asset allocation. Be sure you're meeting your needs for cash and equity growth. Indomitable Horizons Fund can help you with that. Don't forget, 10% of this is just information. So what we just covered, if that is interesting to you, go back and watch this. Hit me up on social media, ask questions. You have to discuss with others to turn the information into knowledge, and you have to practice it by doing it. I will talk about how to practice trading with fake money, and that's a great way to develop your skill. All right, folks, that's my social. That's it for today. Thank you, every single one of you, for being here. Thank you for participating in the chat pane. You guys rock. Follow me on social. Ask me questions on social. Many of y'all know how to reach me on my cell phone, but if you hit me out on social, it actually helps my engagement and helps me get my message out. So that is preferred. But at any rate, thank you so much for being here. And as always, trade on logic, not on hope. God bless you.